What's going on, traders? Welcome to the channel. I'm John. That's Groot. We trade options here. All right, so we are looking at something important. GME has earnings coming up, and the worst feeling ever is IV Crush. If anyone has experienced this, or if you haven't yet and you're looking at options, get ready because you do want to be prepared for something like this. IV Crush is like one of the worst feelings ever because what happens is you will maybe buy a put or a call and the stock goes in the direction you're talking about. You could actually still lose money on this trade because the put and call market gets so inflated and pumped that there's like a natural reaction back down and it's like a crush. So that's kind of the easy way to explain it. What I'm going to show you is a trade I set up in GameStop GME with earnings today at close. I set this up with the understanding that I want to neutralize IV crush. So I'll show that to you in my Tastyworks platform. Then I'll show it to you in Robinhood. If you're trading GameStop GME options or maybe the AMC call options can get really volatile. All right, so we are in GME GameStop. This is the call inputs options chain. So where I'm stepping into is the June 18th. This is the next closest monthly expiration cycle, 11 days from today. And how this call debit spread is set up is you're actually going to have a purchase component that is closer to where the stock is trading, and then you're going to actually sell further away, and you pay what's called a net debit. So you actually pay the broker to initiate this trade. Whereas usually in a credit spread, the broker kind of pays you, but you have collateral that is involved. So debit versus credit, this is a net debit. You pay cash to open the trade type of scenario. So to show you the setup, I actually purchased the 280 call. Calls are on the left, puts are on the right, and I had purchased this. I'll just do that action again. As you click on the ask column, it sets up a purchase of the 280 call. There's a couple issues if you just decide to buy the call only, and this kind of illustrates the IV crush scenario. Well, for one, you're going to pay a lot of money. This thing has bolstered. I checked earlier today, and this 280 call was trading at about 2,000. It was like $2,300 there. Now it's at 42, so it basically doubled with the price movement and kind of the pump of the sort of buy the rumor, sell the news type of scenario. This is exactly that psychological effect where when earnings are coming up, everything gets inflated. You start seeing these options, call and put options start changing hands rapidly. That increases the cost and value, or the inherent value of the option, and this is what sort of helped to bring this value much higher. Well, keep in mind, once earnings have happened, there's gonna be less options trading hands, and as there's not much of a market, this crushes significantly. So this might go lower if we don't move much higher. To neutralize that, I did a couple things. One, I don't want to pay $4,245 for this trade, and I don't want to collect a theta drip or decay against me of 165 a day. That's really bad. What I do to neutralize that, if you just go out, I went 10 points wide, so I went to the 290. I decided to sell or short the call there. And what this does is a couple things. One, look at my theta. It went from negative 165. I'm at +5 now. So this is like a wild phenomenon. I'm almost getting paid by taking this a little bit, but you can see it more reflected in the max loss, max profit column. So I'm paying 350 to open this trade, and my max profit, if things go well, basically if we exceed the 290 by expiration, then I should be getting a profit of 650. So I risk one to make two. Pretty good setup there. So as we're sitting in this trade, you can see I just got lucky enough that we went in the money recently with the GameStop trade. And when it was trading and I bought it, it was around 275, 270, and now we are above it, above my call strike that I purchased at 280. And here's the best part. We're now trading above my break-even point too, which is at 283.50. You just take that 350 you paid, add it on top of your strike, and so 283.50 is the break-even point. If we're at 283.50 at expiration, I don't lose any money, but I don't make any money. And if we're above it, I'm making money. And then you can see here the stock is going to be, one way or the other. It's almost a way of buying stock. It's just now I need it to get above a certain level to be looking good. But keep in mind, I only paid $350 for the possibility of $650 of gains. Whereas if you were just buying stock, pure stock, you don't have to deal with the IV crush scenario, but you're paying $280 for one share. So, if this was to go 10 points, you'd get $10. But for me, I get $650, right? So that's like kind of the difference, or that's the reason that options can be very powerful. So we're jumping into the Robinhood platform. You can see GameStop currently trading at 284.35. As you go here where it says trade GME options, go ahead and click it. You want to go to the correct expiration date. So click on this here, go to June 18th. That is the cycle that we're looking at, the monthly trading cycle. And we want to set up our call purchase. So call buy to open. That is at 280. So I'm going to click the plus, and you'll now see my break even set up here and everything. So break even at 321.45. Max loss is pretty heavy here at 4,000. So let's also do our call debit spread now. Hit sell, go to 290 and click it. And then now you'll see the same setup. So risk 350 to make 650. And we have a break even at 283 and 50 cents. So another way to help neutralize or actually make money from IV Crush is to use something called a put credit spread. And I have a lot of those on the channel. Here's one that is one of my favorites to research.